Welcome to the latest edition of International Tax News. I'm Doug McHoney, PwC's International Tax Services Global Leader. In this edition, we cover selected tax updates from around the world, including my favorite topic, Pillar 2. If you would like to go in-depth on similar topics, check out the Cross-Border Tax Talks podcast, in video on YouTube or in audio wherever you find your podcast. Now turning to our current edition. First, the U.S. House of Representatives recently passed U.S. tax legislation under the reconciliation process. The proposed legislation would reduce the FDII deduction from 37.5 to 36.5%, the GILTI deduction from 50 to 49.2%, and increase the BEAT rate from 10 to 10.1%. In addition, the bill adds a new provision to retaliate against countries that implement an undertaxed profit rule, digital services tax, diverted profits tax, or other unfair tax on U.S. persons. This proposal would increase U.S. net income, withholding, and gross basis tax rates on residents and governments of those countries by up to 20 percentage points and disallow an exemption for foreign governments. It would also add a targeted anti-base erosion overlay for certain corporations that eliminates BEAT applicability thresholds and raises their BEAT rate to 12.5%. It neutralizes capitalized payments and other BEAT exceptions and reduces regular tax liability by all credits allowed. Next, the U.S. Senate will take up the bill, and modifications are expected. Now let's turn to the EU, where the European Commission referred Belgium to the Court of Justice of the EU for incorrectly transposing the CFC provisions of ATAD 1. Contrary to ATAD 1, Belgian law does not allow a taxpayer to deduct from its tax liability the tax already paid by a CFC in the state of tax residence. Considering the broader impact, a potential ruling by the CJEU could provide guidance on national implementation of EU directives on behalf of EU member states. Finally, the Belgian tax authorities on April 10th published a new version of the draft Belgian qualified domestic minimum top-up tax return. Although this version is close to final, it remains provisional until formal publication in the Belgian Official Gazette. The Belgian QDM-TT return should be filed, regardless of whether the transitional CBCR safe harbors are met, on an annual basis within 11 months after the last day of the reporting year in scope. For in-scope calendar year taxpayers, this means the first due date to file the return will be November 30th, 2025. Thank you for reading PwC's International Tax News. I look forward to speaking with you again on the next edition and on the next episode of the Cross-Border Tax Talks podcast.